Everybody, and welcome to the Estate Planning Council annual meeting in a little different format. I'm sorry we can't get together for cocktails after, but we are looking forward to a great program. We have 164 members and guests registered for today's seminar, and I'm really looking forward to it. I'd like to thank all of our 2020 sponsors, but our 5 platinum sponsors: Best Time Financial Services, Canandaigua National Bank and Trust, ES&L Trust Services, LLC, Finger Lakes Financial Services, Inc., and Thorley Wealth Management. Thank you. Please remember that all regular members must attend 2 meetings during the fiscal year from September through June, and any portion of attendance, including the networking, counts. Just remember to sign in and out and complete your evaluation at the end. So please remember to stay on the call at the end. The evaluation form will pop up. Completed, it takes about a minute, and we need to verify your attendance for credit. Please remember again that all attorneys must listen for the codes. Nick will give one, Dean will give one. You must enter those codes on your CLE and complete the attorney evaluation forms. I'd like to very much thank Craig Ginrich for coordination of this meeting. Again, it's my pleasure to thank him very much. It is really my pleasure to introduce our speakers today. Dean serves as the Director of Investment Planning for SEI Advisor Network. In his role, he is responsible for supporting the delivery of advice-driven asset management solutions for SEI advisors and their clients. Prior to joining SEI, Dean was Client Relationship Manager for CMS Companies, Inc., a private equity, private real estate firm located in Philadelphia. Dean was also a personal financial planning technical manager at the American Institute of CPAs and spent several years in personal financial planning practice in the tax technology group of KPMG. Nick received his law degree from the University of Buffalo Law School. He is an associate at Woods Oviatt Gilman, where he focuses his practices in the areas of estate planning, estate and trust administration, long-term care planning, and Medicaid planning. Nick was named the 2016 Rising Star by Super Lawyers magazine. Please take the time to read both speakers' entire bios in our materials. It is now my great pleasure to turn the program over to Nick.
Thank you. Yeah, I'll start it. So it seems like a lifetime ago that I was talking with Craig about getting this program together, and just a few things might have happened in life since January that could potentially have overshadowed what was really a very big change in the law. You know, as we hope to reopen a little bit more as time goes on, it's kind of nice to come back to something that at this point, even not being a big change, seems a little bit more back to normal. So we're going to talk about the Secure Act today. As soon as I can figure out how to advance the slides and not alter the screen in front of you. Of course, there's going to be, there we go. Okay, so it's nice to be back and do all this again. So we're going to address some things with respect to the Secure Act, and what I'm really going to talk about before turning it over to Dean is I'm going to give us a little bit of an overview with respect to required minimum distributions, minimum required distributions, the interplay with the Secure Act, and then also talk about then trusts and their interplay with required minimum distributions. You know, as a small caveat, you know, with 25 minutes to talk, I'm going to assume some basic familiarity with the old rules regarding required minimum distributions. So the required minimum distribution overview will not be comprehensive, but it should give enough context to put the secure changes, to highlight the secure changes. So it didn't really get much simpler for us as far as determining what level of beneficiary you are. We have to deal with different levels of beneficiaries now, and we have to deal with potential differences with respect to time and the like. So underneath the required minimum distributions overview, I want to touch on the date of death and how the date of death impacts the applicable law. I want to overview the new classes of beneficiaries that have been devised through the Secure Act. And I would like to then discuss the RMDs for each particular class. And so that'll be our overview of RMDs before we launch into trusts. With respect to the date of death and the applicable law, deaths prior to 2020 are governed by the old rules. So 2020 is really your line in the sand. Death after 2020 is governed by the Secure Act. And what's important to really drive home on that point is that deaths after 2020 and all deaths after 2020 are impacted by the Secure Act. And so if Nick inherits dad's IRA pre-2020 and has an inherited IRA, and then Nick passes away after 2020, leaving it to his son Levi, the result is that Levi is subject to the Secure Act rules with his receipt of the inherited IRA. So moving to classes of beneficiaries, non-designated beneficiaries haven't changed as far as what falls underneath that category. We've got non-qualified trusts if they're drafted such that they're non-qualified, estates or charities. And the big ticket item here is really this second class of beneficiaries, which is the eligible designated beneficiary. And this is a big step away from the old law. And so there are 5 different categories of eligible designated beneficiaries. And those 5 different categories are the spouse, a disabled beneficiary, a chronically ill beneficiary, both of which I will come back to a little bit later in the slideshow to talk about definitions because those aren't as readily definable on their face. And then individuals who are not more than 10 years younger than the decedent, said affirmatively, individuals within 10 years of age of the decedent, and finally, minor children of the decedent during minority. These 5 classes will qualify as eligible designated beneficiaries and get special treatment under the Secure Act. So coming back to definitions with respect to disabled beneficiary and chronically ill beneficiary. A disabled beneficiary definition really falls to the Social Security disability definition. And so it's based on a substantial gainful activity standard. An individual shall be considered to be disabled if he's unable to engage in any substantial gainful activity by reason of disability. It also goes on and says that an individual will not be considered to be disabled unless furnishing proof of the existence of that disability as the secretary may require. With that, to me, and this is a place where I suspect we'll end up having further regulation coming out, significantly limits the applicability of this potential category. Because, you know, my wife, for instance, is a Social Security disability attorney. She will tell you, and everyone who works in that area will tell you, that it is no quick matter to furnish the necessary proof to the Social Security Administration. And since we're determining these statuses as of date of death, it seems as if this would be a relatively narrow definition, which then brings you into chronically ill, which broadens substantially and provides a bit more access. And so under the chronically ill beneficiary designation is really centered around the individual's ability to undertake activities of daily living. And the basic baseline of this is the inability to undertake 2 activities of daily living for 90 days due to loss of functional capacity. I find this similar to 2 activities of daily living I guess, interesting, but I'm not exactly sure how that would play out. So if it's similar to 2, which is effectively being 2, then that also counts as 2. And then the institutionalization one makes sense. You know, if the individual is institutionalized as a result of the inability to undertake activities of daily living, then certainly at that point, chronic illness status would be obtained. So those are where those definitions come from. If anyone is interested in the sites to where those definitions can be found, certainly happy to provide them. And then we come to designated beneficiaries. So those were the 5 eligible beneficiaries with the special treatment of the definitions of chronically ill and disabled. And then once we get past them, everyone else who isn't a non-designated beneficiary or an eligible designated beneficiary falls into the designated beneficiary category. So painting in very broad strokes, the summary with respect to required minimum distributions for each class of beneficiary is that non-designated beneficiaries, we have the same old rules. Eligible designated beneficiaries qualify for the lifetime stretch with some caveats that we'll get into in a bit. And designated beneficiaries are now stuck with the new 10-year payout rule. And we'll dive into some of this just a little bit deeper right now. So with respect to non-designated beneficiaries, everything centers around the required beginning date. And the required beginning date changed underneath the Secure Act, and it moved from 70.5 to 72. So in exchange for forcing you to leave your IRAs to your children who are probably in their high income earning years and making them pay it out over 10 years, the IRS gave you an extra 1.5 years without required minimum distributions. So fair trade. And what is interesting about this is that you're underneath a 5-year payout if you die before your required beginning date. And after your required beginning date, after 72, it's your life expectancy based on the single life tables. So what's interesting about that, and this is probably more of an academic point than any sort of practical point over the long haul, is that a 72 to 80-year-old has a life expectancy on the single life tables that exceeds 10 years. So a 72-year-old's life expectancy is 15 point something, an 80-year-old's life expectancy is 10 point something, and each of those would exceed the 10-year mark. So you could imagine a hypothetical situation with a 72-year-old client saying, oh, well, let's designate your estate as a non-qualified beneficiary, non-designated beneficiary, and you can get an extra stretch out of that. I actually ended up emailing Natalie Choate in the middle of all this, and to sing her praises even more with all of the information that she juggles on a daily, on a regular basis, she actually found time to respond to me, which I was thrilled about. And she said effectively, it's very likely to see regulations come out on this point, and it's very likely that they're going to say you can't have an end around here. It's going to be the lesser of the two available. So you'd end up getting stuck with a 10-year payout if you fell within the 72 to 80 and had a non-designated beneficiary. So in any event, it was an interesting wrinkle with respect to this law, but probably one that's a bit more academic. With respect to required minimum distributions for eligible designated beneficiaries, the general rule is that the required minimum distribution is based on the beneficiary's life expectancy under the single life tables. And so that's basically saying to you, yeah, you're going to get the old stretch. With respect to disabled beneficiaries and chronically ill beneficiaries, they only qualify for the rule if they are disabled or chronically ill at the participant's death. So that again comes back to my point earlier about the disabled beneficiary definition being narrow enough that you would have to have already really qualified for Social Security disability. And then at the participant's death, the other interesting aspect of this is that we really have no guidance whatsoever regarding government oversight on this determination. At this point, I suppose the most likely outcome is that you furnish whatever you need to furnish to set the required minimum distributions with the custodian. And then if the government's going to challenge it, they challenge it on audit. Wow. So I guess it would be interesting to see what a retrospective look at how chronically ill you were, 3 years or less ago was. But it'll be interesting to see how this unfolds over time. Minor children is the general rule here is that they will get the stretch, but they only get it if they are of the decedent. So we're not talking about nephews. We're not talking about nieces, grandchildren, anything along those lines. We are talking solely about children, minor children of the individual who has passed, and only through their minority. Minority being a term that is not defined in the Secure Act. Presumably then state law governs, and New York's age of majority is age 18, which would mean that if Nick passed away and left all of his IRAs to his children Levi and Lila, regardless of the fact that they're both minors at this time, by the time they hit 28, it's all going to be paid out to them. So as soon as you hit that age of majority, it flips and you get into the 10-year payout rule. So any minor child gets that, you end up getting it out, finally paid out at age 28. So that's the overview with respect to RMDs generally, and we're going to move into trust at this point. And really, the tax issue becomes a big burden when you're talking about it with respect to RMDs. So when we're talking about Secure Act and utilizing planning and trust planning, we're much more concerned now with taxes than we were previously, even though, of course, you're always worried about properly preparing for the income tax burden when dealing with trust planning. So with respect to my chat on trusts and RMD planning, I am going to focus primarily on general type conceptions of trust in the conduit trust and the accumulation trust. I will touch on a particular type of trust, accumulation trust, in the supplemental needs trust. And then I'm going to leave some other trusts to Dean to talk about when I pass the microphone over to him. So in those general categories, conduit trust, accumulation trust, breaking those down, and this is, I'm sure, probably familiar to many of the members of the EPC, a conduit trust just directs the distribution of the required minimum distribution to the conduit beneficiary. So trustee, here is my IRA. I direct that you receive the RMD on an annual basis, and I direct that you pay it out to the conduit beneficiary on an annual basis so that it flows straight through to them, and by virtue of that gets look-through status. Accumulation trust, on the other hand, allows the trustee discretion to distribute the required minimum distribution to the beneficiary and or retain a portion or all of the required minimum distribution within the trust. And so in this sense, trustee, here's my IRA. Yes, you're going to get distributions out of it, but for the beneficiary, please make distributions based on their health, education, maintenance, and support. Whatever they need, make the distribution for them. If they don't need it and you think it's better, retain it. When we're talking about looking through the trust to deem or to gain a particular status of distribution, the concept of sole benefit is still active with respect to the Secure Act. And the sole benefit remains the only way to look through the trust for purposes of gaining eligible designated beneficiary status. I suppose as I read that slide, that's overly broad because I'm immediately at the end of the slide saying, hey, we're going to talk about supplemental needs trust later. So there's a caveat to that, but generally speaking, sole benefit is the way to get through to eligible designated beneficiary status. With respect to a conduit trust, this is no problem. A conduit trust, by definition, is a sole benefit trust. Here's the IRA, pay the IRA required distribution out to the beneficiary. There, it's for the sole benefit of that individual. On the accumulation trust side of things, however, there is no sole benefit status. And so you really generally, with the exceptions being a supplemental needs trust, can't attain eligible designated beneficiary status no matter who the beneficiary is. And the logic behind that set forth in that regulation I gave below, which is effectively just saying, look, you've given your trustee discretion to distribute. They may exercise that discretion, they may not exercise that discretion. There's a remainder beneficiary, and so since even if there is only one lifetime beneficiary, because there's discretion and it could pass to the remainder beneficiary, we don't have sole benefit status. And so you don't have that ability to look through the trust. So coming to conduit trust and their issues as a result of these Secure Act updates, well, it's pretty big. The conduit trust, since it says pay only the RMD for the beneficiary, well, the 10-year rule only doesn't really create a required minimum distribution. The 10-year rule simply says make sure everything is paid out within 10 years of inheriting the IRA. So in a strict conduit trust with no discretion to make additional distributions, you're forced into a situation where you sit on the IRA for 10 years and at the end of 10 years have a huge tax event. If on the other hand, the conduit trust allows for more distributions, you could then realize the income piecemeal over the course of 10 years. But really, if you were drafting this conduit trust pre-Secure Act, you weren't you weren't thinking about it being paid out in 10 years. And so you've significantly accelerated that payout and in probably most cases have defeated the purpose of your conduit trust. The conduit trust for a spouse will still qualify for stretch under the pre-secure rules. So you do have that status as well. The Secure Act with respect to accumulation trusts, on the other hand, really boils down to an income tax versus control balancing issue. And that's what you're faced with as an estate planner consulting with a client. The client may be thinking, oh, my son Levi is very responsible, but he's too young to be receiving any money. I'd really like him to get this money outright, or I'd really like to get this money into a trust and delay it till he gets a little bit older. And you may think to yourself, okay, well, we've got the accumulation trust, we can designate it in there and that's fine. But the problem being that trusts are subject to compressed tax brackets. And there's my 5-minute warning. So with that problem and that compressed tax bracket with respect to the trust, you're wary about subjecting those required minimum distributions to a top tax bracket as soon as those required minimum distributions reach at $12,900 and exceed the trust top's tax bracket. So you're really ultimately weighing control versus income taxes. Now you may utilize concepts like distributable net income and just say, well, you know what, I'm not in a position to make that decision now, so I'm going to let the trustee make that decision. And we'll still designate it to the trust, and hopefully Levi remains responsible, and we'll pass things out to him, and and we can tax it at his personal bracket. But I don't want to make that decision in advance. I'll kick the can to the trustee and let the trustee make that decision down the line. So what it really boils down to, even with all the different permutations of the Secure Act in this accumulation trust, is a balancing of control versus income taxes. Some clients are going to really weigh control heavier than they're going to weigh the income taxes. Some clients are going to weigh the income taxes and say, you know what, let's forget all this and let's just get it to them outright. And one of the nice parts about that, especially with the distributable net income aspect and the fact that beneficiary designations are so easy to change, you could create the trust underneath the will and say, for now, we're going to designate the beneficiary in one way. And if things change, we'll designate the beneficiary in another way. And you really don't have to spend a lot on the attorney's fee side of things at all on that front. So in any event, that's the main issue. Moving to supplemental needs trust. This was a huge win for groups like NALA, the National Association for Elder Law Attorneys, because supplemental needs trusts were completely disregarded in the first draft of the act. And what advocacy groups for disabled individuals came forward and said, and they said, look, you're taxing our most vulnerable population as if they are our most affluent. People can't leave the disabled population money outright without destroying their government benefits and programs that they rely on for day-to-day living. And so they have to leave them into these accumulation trusts. They have to leave them into supplemental needs trusts. And if you don't make a carve out for supplemental needs trusts with respect to taxation, not only do they have to leave it there, then they have to pay tax at the top tax bracket, what will effectively probably be the top tax rate. So that actually held sway, and people listened, the legislature listened, and updates were made, and that was great because the Secure Act says that an accumulation trust for the sole life benefit of a chronically ill or disabled beneficiary will in fact qualify for the old stretch rules. And on the death of the beneficiary, only on the death of the beneficiary and passing to the remainder beneficiaries will the Secure Act 10-year payout rules then kick in. I'm running out of time, so there are some interesting permutations about what would mean to have a disabled beneficiary have a remainder beneficiary that was also a disabled beneficiary, and we can go down the rabbit hole there. But the good news is that the supplemental needs trust, special needs trust planning has helped substantially. So with that, I think I've hit my 25-minute mark, right, Lynn? So I'll turn it over, and I'll give everything over to Dean. And as soon as I press the stop share button, I can't tell you how many times the Estate Planning Council has trained me on how to press the buttons on this thing. So this is entirely my fault. Thanks, everybody.
Nick, would you please give the code?
The code is 7184. 7184.
Thank you.
Well, good morning, everyone. This is Dean Mioli, and we're going to build on what Nick has started. And the question that I get all the time from advisors and clients is, how do I get the stretch back? And we're going to take a look at 3 techniques to do that. One is the power of the Roth conversion. One of the outcomes you're going to have today is taking a look at the Roth conversion and the immense power that this can provide. And I do believe that for 2020, this is the #1 planning idea. Another outcome is going to be, we're going to take a fresh look at disclaimers and the use of disclaimers in the post-Secure Act environment. And number 3, as your third outcome, we're going to look at CRTs, and we're going to show you how to use an old dog for some new tricks. So let's get started. Now, this is a little grid that I think would be very helpful in potentially working with your clients. And what we're talking about here today is essentially, are your clients interested in enhancing wealth transfer? That's the question. And if you get a yes, then you're going to work through the rest of this diagram. For instance, are they charitably inclined? Well, if that's the case, then we're going to be looking at CRTs or direct charitable gifts. Well, let's say they're not so charitably inclined. That's okay. Then we're going to be looking at exploring Roth conversions and potentially looking at the use of disclaimers. Or we could be looking at all of these ideas. But essentially what we need to do is really looking at ways to decrease the amount of income tax that's going to go from one generation to the next. And the techniques we're talking today are primarily geared on managing that income tax bill. Well, first, let's take a look at Roth conversions. And what I have on the right side of this chart are the 2020 tax rates for single taxpayers and married filing joint taxpayers. And what you'll see is the immense difference between the tax rates for singles and married filing joint. Let me point out an example. If you look across the 24% bracket, a married couple can still be in the 24% bracket up to $326,600 of taxable income. Now, if you had that level of income as a single filer, where are you? Well, you're down in the 35% bracket. That's a huge difference. So one idea, certainly when you're thinking about Roth conversions and you're working with a married couple, is it's much better to be doing Roth conversions when people are married than when someone's deceased and then thinking about Roth conversions after someone has passed away. And right now, I would argue on a historical basis that tax rates are extremely low. And Roth conversions in the 10, 12, 22, and 24% brackets are essentially a no-brainer. And they should be looked at each and every year. Now, a couple other benefits of the Roth conversion is you can pair doing a Roth conversion with other tax strategies. For instance, we have some fallout from the COVID-19. There's many business owners that have had to shut business for a while, maybe generating losses, potentially an NOL. Well, let's try to turn lemons into lemonade here and pairing a Roth conversion with a business loss this year, okay? Maybe they have a charitable contribution carry forward. Maybe they have investment tax credits. Maybe they sold a rental property and passive losses were unleashed. There are many ways to get a free Roth conversion. And here's an alert for 2020. As part of the CARES Act, we have what's called the Qualified Charitable Contribution, the QCC. Now, what has happened here is they temporarily suspended the 60% adjusted gross income limitation for cash contributions. It is now 100% of AGI for cash contributions. The caveat is it has to go direct to charity. You can't use a donor advised fund, can't use, for instance, a charitable remainder trust. But let's say you have a client that's already itemizing deductions. They're already over the standard deduction. Their taxes, their mortgage, their charitable contributions are already over. For a married couple, I believe that's a little under $25,000. So they're either thinking about doing a $50,000, $100,000 Roth conversion. They're charitably inclined. Well, let's say they give $50,000 in cash to their favorite charity. Well, they can marry that with a $50,000 Roth conversion. The one offsets the other. Complete offset. So that's extremely powerful right now. Extremely powerful. So clients do have some apprehension about paying tax. Let's figure out ways where they don't have to pay tax. Another small benefit of doing Roth conversions right now is, of course, the age for RMDs has been pushed out from 7.5 to 72. So now you have a little bit more time to do these Roth conversions. Roth conversions don't have to be done all at once. They can be done over a series of years, okay? Partial Roth conversions, okay? So it's about tax bracket management. So for instance, I go back to my example. If I have a married couple with their, let's say they have $225,000 of taxable income, that puts them in the 24% bracket. They could do a $100,000 Roth conversion and still be in the 24% bracket. No, that might be a little high, but you could easily see that they did a $25,000 or a $50,000 Roth conversion. guess what? They're still in the 24% bracket. One of the most advantageous things about the Roth conversion is when someone inherits the Roth, there's a couple of great benefits. One is post-death distributions to a beneficiary are tax-free. That sounds good to me. I get a very warm and fuzzy feeling when I hear those words together, tax and free. Okay. And as Nick had mentioned, of course, most people will fall under the 10-year rule on taking distributions on an inherited IRA. But guess what? If I inherited a Roth IRA, which I will from my father at one point in my life, I don't have to touch that account until the 10th year. Okay, that's the only required minimum distribution is that final year I have to empty the account. So I get 10 more years of tax-free growth. Okay, very nice to have that as a benefit. Now, a couple other things to keep in mind. Of course, if someone has estate tax issues, which I would argue that the exemption that we have right now, lifetime federal gift and estate exemption at $11.5 million per person, we know that's not sticking around. It's supposed to end at the end of 2025, and our estimates based on inflation, it's going down to about $6 million, depending how this election goes in the fall. If Senator Gomez and Senator Sanders get their way, that exemption could easily go to $3 million. So even if you had to pay some tax on a Roth conversion, that would reduce your taxable estate. And another thing about Roth conversions is, of course, everyone can do it. There is no limit. As long as you have a traditional IRA, you don't have to have earned income or anything. If you have a traditional IRA, you can do a Roth conversion. There is no limit. The one thing is, it's a one-way street. When you do a Roth conversion, there's no more recharacterizations. But when you take Roth IRA distributions, let's say as an owner, okay, or even as an inheritor, that has no effect on the taxation of your Social Security benefits. And it is not considered when calculating Medicare insurance premiums, which you essentially have a 2-year look back, which is pretty nice. And of course, another thing that we're dealing with, certainly with upper income taxpayers, is the 3.8% Medicare surtax. Okay. Now, that's certainly when you do a Roth conversion, that could have a bearing on that tax being paid. But when you take distributions from a Roth, that is not factored in either as net investment income, nor is it in the calculation of generating MAGI, modified adjusted gross income. And of course, one of the easiest benefits of the Roth conversion is whatever you convert prior to your minimum requirement of distribution date, your future RMDs will go down because Roths don't have RMD requirements as the original owner. And of course, the one nice benefit between husband and spouse is that, if someone dies, husband dies, the spouse can take over that Roth. And of course, potentially extend when, continue to have that tax-free growth. And again, no RMD requirement. So pretty nice. I think the Roth is something that's definitely going to be on the agenda. And I think the urgency of Roth conversions is critical right now. Now, let's move on to our next planning idea, which is the use of disclaimers. Now, it's quite common when we're planning with clients that with the provisions around a spouse can roll over the deceased spouse's IRA, that prior to the Secure Act, it was very common to say, all right, I'm going to make my husband's traditional IRA mine, I'm going to make my Roth IRA, his IRA mine. And there really wasn't any real downside to that. But again, we're trying to manage that income tax bill. So let me give you a quick example here. We have a husband who's age 74, he passes, he has a $1.5 million IRA. A spouse, a little younger, age 73, she has her own sizable IRA. They're financially well off. The spouse is the primary beneficiary of the husband's IRA. They also have 2 adult children. They're both currently in the 24% bracket, and they are the successor beneficiaries of their father's IRA. So option 1 would be spouse rolls over husband's IRA into her own. Now she has a $2.5 million IRA. Okay. A little later on in her life, she passes on. Okay, let's just assume that the RMDs and the growth of the IRA are the same. The children both stand to inherit and split a $2.5 million traditional IRA. So now each child has a 10-year stretch to bring in $1.25 million each into their income tax, $125K per year. So assuming the child's remains single, in my example, and they're picking up an extra $100,000 per year, okay, that is going to push them in from the 24% bracket into the 35% bracket. So that's not very good tax management. It reminds me of the movie Wall Street and Gordon Gekko and Bud Fox. And Bud Fox asked Gordon Gekko, how much is enough, Gordon? How many yachts can you own? How many homes in the Hamptons can you own? And I'm being a little facetious here, but my point is with clients that have significant wealth, do they need to take over the entire IRA to be financially well off? You know, maybe they have 5 or 10 or $15 million, and they might say, you know what? I know the future's uncertain, but I'm feeling pretty good that I could get by with $4 million or $6 million, and I could give something to my children now and not wait upon my passing. So we could look at this a little bit differently. Instead of the spouse taking the entire $1.5 million, she disclaims $800,000 and rolls over $700K. So here, the two children will split the $400K and spread that over 10 years, because that would make the most sense. You probably want to, again, manage your tax bracket. Very important, pick up the $40K per year. And by picking up just $40K per year, they're going to get a 10-year stretch. They're still in the 24% bracket. No just real big disruption to their tax situation. They are getting some nice money to supplement their lifestyle. Pretty effective. And then when the second spouse dies, 11 years later, assuming RMD is equal to portfolio growth, they are now going to split a $1.7 million traditional IRA. And they're going to get another 10-year stretch. So this is the power of using the disclaimers, is that they get 2 10-year stretch periods instead of 1. And that sounds better to me. Okay? And potentially along the way, the spouse could have done some Roth micro conversions. Again, trying to manage her own tax bracket, getting some Roths converted. Better would have done it when they were both married, but hey, someone passed, but you're still looking at Roth conversions. And it's important on how you have those beneficiary designation forms set up on the IRA accounts, where you could have primary as the spouse and contingent as the children, to make these disclaimers work. Now, in the notes section of the slide, you can go over what's a qualified disclaimer. Of course, when the spouse disclaims, she cannot direct on where the money goes. It has to be done within a certain amount of time, 9 months, and there's some other requirements, has to be in writing, etc. But I think this is a fresh look at the power of disclaimer to take a single 10-year stretch period and make it a 2 10-year stretch period. So a pretty important thing, I think, now going forward is looking at these disclaimers. Now let's take a look at the last idea, which is leaving your traditional IRA to a CRT. Nick was talking about earlier about all the problems now with the Pre-Secure Act type of trust, which was very famous, was the use of the conduit trust, or there's issues around using might be better to use an accumulation or discretionary trust. You have income tax issues, not really good answers there in some cases. So let's look at a fresh idea here using a CRT. So what are we doing here? Well, we're going to have the CRT as the beneficiary of an IRA. So upon someone's death, they would leave some or all their IRA to a CRT. You would have a charitable remainder document written up, ready to go, lying dormant. And then, of course, at the owner's death, assets would transfer from the IRA to the CRT. And again, what we're working on here is income tax deferral. And of course, that transfer from the IRA to the CRT is tax-free, okay? The beneficiaries of the CRT could be, again, my children, and there's no taxable income to them until they start receiving distributions from the CRT. And the CRT functions like a see-through trust, pre-Secure Act. This is the genius around using the CRT. You can base the payouts based on life expectancy. So imagine two children inheriting a CRT, meaning via the IRA. IRA funds the CRT. Now they're income beneficiaries of the CRT. They're age 45, approximately. Well, their life expectancy is probably 40 years. Now they have a 40-year stretch. That sounds a lot better than 10. Of course, we would expect that there be some charitable inclination to use one of these, okay? There's other benefits of the CRT too, including creditor and creditor protection, income tax management. It puts kind of a governor on things. I mean, a lot of things we hear from clients is, I don't really know if my kids are very good at financial management. I'm worried that they'll not handle this money that I've saved so long for properly, okay? Of course, if you're gonna set up a CRT, you might want to have a corporate trustee, okay? Who's going to be the charity? It's hard to think about that. You might use a donor advised fund. That's a real easy suggestion that your family, after your passing, could continue to use that money in charitable fashions, okay? So there's some very good planning. Let's take a look at a chart. Now, I'm not sure if action will happen on this. We'll take a look, but we have it. Oops, it does not. So we will go back. But essentially, I'll just use my pointer. You have a donor. And what they're going to do is at death is they're going to transfer their IRA assets over to the CRT. It's going to be invested in a strategy. Here, a little shameless plug for my company, an SEI strategy. It should be tax managed in most cases. Okay, so you're going to use tax managed equity, municipal bonds. The CRT can be structured to be paid out to the income beneficiaries of the CRT in a few different ways. It can be based on multiple life expectancies. It could be up to a 20-year term. So you don't even have to look at life expectancy. And right now, based on current Section 7520 rate, which is at its low in history at 0.6%, you could do a 20-year term CRT and pay out 10.5% per year. Now, this is structured as a child remainder uni trust. Okay, that gives us the most flexibility. So we do it that way, they pay out to the income beneficiaries for 20 years, 10.5% of the trust value each year. After the 20-year term, what is left, if anything, would go to the public charity. And again, that could be a donor advised fund, okay, or the other named charities inside the CRT. So this really accomplishes quite a bit. If the client has some charitable intent, yes, something's going to go to charity in the back end of this trust. We get the stretch back. If we even do a 20-year term, we just doubled the stretch term, okay? And if they do life expectancy over multiple lives, you could have the spouse as a beneficiary with the children. You could have the children. Right now, if you had a single life, you could have someone as young as 28, a 5% payout would work on a CRT. And generally, that is the lowest payout of a CRT is 5%, correct? With a dual life expectancy, the average would have to be around 38, 39 years old, and it would work, okay? So we're getting a lot of interest from our advisors on modeling the CRT as an IRA beneficiary. I think it alleviates a lot of the issues that you might see with a conduit or discretionary trust, and instead use the CRT, okay? Of course, the income beneficiaries would get a K-1 each year. They're going to have to pick up taxable income. But here's an interesting thought. Of course, when you move an IRA into a CRT, okay, those assets move over. That's ordinary income. And Code Section 664 is the code section for CRTs. And with CRTs, there are 4 tiers of income: ordinary, first, then long gain, qualifying dividend, municipal income, and then fourth is principal. Of course, when you move over IRA assets into a CRT, we're going to be paying out ordinary income for many years. I don't know, 15, 20 years, depending on the payout. But after we break through that ordinary income layer, after we've paid out all that IRA money, of course, over that time period, we've been investing in stocks and municipal bonds. The money coming out of the CRT to pay the income beneficiaries is going to start to be tax-favored income. So we'll do our best not to generate any ordinary income, so then we'll break into that second layer of paying out long gains and qualifying dividends. We'll start to spin straw into gold. Okay, normally we use CRTs when we put appreciated assets in and then sell them inside the CRT. Why? Because we want to create that big second tier layer, so when we pay out distributions, it's all tax-favored income. We can get there with transferring an IRA to a CRT as well, but it's going to take a little bit of time to make that happen. And with that, I will give you the code, as my legal team would like me to show this disclosure, 5936, 5936. And with that, Nick and I, we have figured out that the NFL Super Bowl is going to be the Eagles versus the Buffalo Bills. And I'd like to see someone come up with two more teams, but I think they're the two teams destined for the Super Bowl this year. And with that, we'll take your questions.
With an obvious Bills win on that one.
We're going to play the game first, Nick.
Yeah, if history says anything, it's that the Bills would win the Super Bowl.
So I
Circle the wagons.
I have one question that hasn't been answered. Can you convert an existing inherited IRA into an inherited Roth?
The question is, can you an existing inherited IRA to an inherited Roth? The question is no. You cannot do that. Only the original IRA owner can do a conversion of a traditional IRA to a Roth. So if I inherited my father's IRA, I am not in a position to convert that to a Roth.
Please, I don't have any other questions. Please type in the Q&A if you have additional questions for Nick or Dean. And I'll give you a couple seconds to do that. If I don't have any additional questions, I would very much, Craig also chimed in, thank you both. Nick and Dean, thank you for the wonderful presentation this morning and your time. The gift cards are in the mail. I would love to be able to hand them to you personally. Unfortunately, we can't. So thank you again, both of you, for the wonderful presentation.
Thank you.
Thank you, Lynn. Thanks for having us.
Please remember to stay on the line for the evaluation and for the portion of our annual meeting. Our next meeting, probably in a Zoom format, although we're hoping in person, will be Thursday, September 10th at 8:30 in the morning, and the subject will be trust litigation. So we'll give you more information as the time progresses and the board decides how we're going to handle our meeting going forward. I'd now like to do the annual portion of our meeting. And I'm going to just start with my own thank you. It has been a real honor and privilege to serve as the president of the Estate Planning Council. I'd very much like to thank our members and the board for the tremendous support and participation this year. It has been a pleasure serving with such a great group of professionals. I would also like to send a very special thank you to Rick Rivers, Karen, Terry, and his entire team for not only the support this entire year, but especially over the last several months as they have navigated our new normal and gotten us into Zoom and made us more comfortable than we've been before. So thank you again to everybody. It has been a real honor. I'd now like to review the slate of officers, please. Our president for next year is Lorraine Welch. Our first VP is Don Tweetmeyer. Our second VP will be Elizabeth Thorley. Our secretary is Maria Caton. Our treasurer will be Mary Sabat, and I will move into immediate past president. Our new executive committee members for the year 2020 and through 2023 is Brett Carselli, Craig Ginrich, Catherine Johnson, Rick Marchese Jr., and Jacqueline Reardon. Barbara Clemens has also agreed to fulfill the last term for Allen Ginsberg. I believe our voting will now come up. Am I correct, Karen? So while everyone is voting, I would also like to very much thank our executive committee members that are leaving the board for their service. Kevin Best. Kevin, thank you for your hard work on nominating all of our new executive committee members in the board. Allen Ginsberg, Ellen Duell, Susan Harradine, Leslie Rector, and Jeanette Townsend. Again, thank you all for your service and for your commitment to the EPC.
Just a quick question. I'm not quite sure how long this is supposed to be up.
Probably about a minute or so. See how many people vote.
Thank you.
Are we getting everybody, Karen?
It says 100 people have voted. We're about 75% at this point.
Okay, wait another second or so, and then we'll display the results. I wish I could see everybody's hands raised and give everybody a big round of applause.
All right, folks, we are at the 2-minute mark, and it looks like I'm going to end the polling now with your permission, Lynn.
Yes, please, Karen, thank you. And we have 100% agreement to our 2020-21 elections. Thank you very much for the vote. Congratulations to the new board. Lorraine, I know you're going to do a fantastic job as next year's president. I look forward to staying involved. Everyone, I believe that concludes our meeting, and have a safe and healthy summer. I look forward to everyone getting together in September.